Imagine a seemingly stable house of cards. Now picture one card being pulled away. What happens?
Apple's up more than 6% right now. Google a
400 points higher. Yes, indeed. The market down by between 3 and 4.5%. The stock market is now down 21%.
In the financial world of 2008, the removal of that card was the collapse of Lehman Brothers, a major investment bank. This event triggered a financial earthquake, shaking markets worldwide. Today, we'll explore the story behind Lehman Brothers' fall, the events leading up to it, and the lasting impact it had on the global economy. History of Lehman Brothers. Our story starts in 1850, not on the bustling streets of Wall Street, but in a small town in Alabama. Three German brothers, Henry, Emmanuel, and Mayer Lehman, immigrated to the United States and opened a small dry goods store. They sold fabrics, clothing, and other household items, catering to the local community. This was a modest beginning, but the Lehman Brothers were ambitious. They saw an opportunity in the cotton trade, a booming industry in the South at the time. They shifted their focus, becoming middlemen who connected cotton farmers with buyers in the Northeast. This venture proved successful, and by the mid-1800s, the brothers had established themselves as prominent cotton traders. The next step in their journey took them to New York City, the heart of American finance. In 1858, they opened a brokerage firm on Wall Street, leveraging their experience in the cotton trade to facilitate transactions for other businesses. The firm thrived, and over the decades, the Lehman Brothers expanded their services. They became involved in underwriting, helping companies raise capital by selling stocks and bonds, mergers and acquisitions, advising companies on buying and selling other businesses, and government bond trading. By the early 20th century, Lehman Brothers had become a major player on Wall Street, known for its aggressive trading strategies and its role in some of the biggest financial deals of the era. The subprime mortgage crisis. Fast forward to the early 2000s. The US housing market was experiencing a boom. Home ownership rates were rising, and property values were steadily climbing. This created a seemingly perfect opportunity, a chance for more people to achieve the dream of owning a home. However, there was a dark side to this boom. In an effort to capitalize on the hot market, banks started offering mortgages, loans to buy houses, to people with lower credit scores and riskier financial situations. These were called subprime mortgages. Here's why subprime mortgages were a ticking time bomb. Typically, when someone applies for a mortgage, their creditworthiness is carefully evaluated. Their income, job stability, and past history of repaying loans are all taken into account. This helps lenders determine the risk of default, the chance that the borrower might not be able to make their monthly payments. With subprime mortgages, these strict criteria were relaxed. People with a history of late payments or lower incomes were still approved for loans. The justification: some lenders believed that rising home prices would ensure that even if borrowers struggled to make payments, they could always sell their house for a profit and use the proceeds to repay the loan. This created a situation where people were borrowing money they might not be able to afford, all based on the assumption that the housing market would continue to rise indefinitely. Lehman Brothers exposure and risky bets. Lehman Brothers, like many other financial institutions at the time, saw subprime mortgages as a profitable opportunity. They heavily invested in these loans, believing they could generate significant profits. They also went a step further, creating complex financial instruments called mortgage-backed securities, MBS. Imagine taking a bunch of subprime mortgages, bundling them together like a package deal, and then selling them to investors as a single investment. These MBS were marketed as a safe and reliable way to gain exposure to the housing market. The idea was that even if some individual subprime mortgages went bad, meaning the borrower defaulted, the overall value of the MBS would remain stable. This was based on the assumption that a few bad loans wouldn't outweigh the good ones. However, the problem was that the foundation of this entire system, the subprime mortgages themselves, were shaky from the start. Lehman Brothers also made another risky bet. They borrowed heavily to finance their investments in subprime mortgages and MBS. This increased leverage, borrowing money to invest, allowed them to potentially make bigger profits, but it also magnified their potential losses. In essence, Lehman Brothers was putting all their eggs in one basket, the basket of the US housing market continuing to rise. By the mid-2000s, cracks began to appear in the seemingly perfect facade of the housing market. Home prices started to plateau, and then, in 2007, the bubble burst. Foreclosure rates skyrocketed as borrowers who couldn't afford their subprime mortgages began defaulting on their loans. This sent shockwaves through the financial system. The value of subprime mortgages declined, and the complex MBS built on top of them started to unravel. Lehman Brothers, heavily invested in these assets, watched their portfolio value shrink dramatically. The aggressive leverage they employed magnified the losses, leaving them in a precarious financial position. Imagine this. Lehman Brothers was like a house of cards built on a foundation of sand. As the housing market crumbled, the foundation gave way, and the entire structure began to fall apart. With their access to credit drying up and facing mounting losses, Lehman Brothers explored various options, including a potential merger with another bank. However, negotiations fell through, and on September 15, 2008, Lehman Brothers filed for bankruptcy. This event sent shockwaves through the entire financial system. Banks became wary of lending to each other, fearing they wouldn't get their money back. This credit freeze crippled businesses and consumers who relied on loans to operate and invest. The domino effect had begun. The domino effect, from collapse to global crisis. The gamble Lehman Brothers made ultimately backfired. Home prices started dropping, and a significant number of subprime borrowers began defaulting on their mortgages. This triggered a chain reaction. The value of MBS drops sharply. During the subprime mortgage crisis, Lehman Brothers' investment in MBS decreased in value as more subprime mortgages failed. These securities, once seen as safe bets, were now practically worthless. Losses mount for Lehman Brothers. With their MBS holdings losing value, Lehman Brothers faced massive losses. The aggressive borrowing they engaged in further amplified these losses, putting them in a precarious financial position. Loss of confidence. News of Lehman Brothers' troubles spread quickly throughout the financial system. Investors lost confidence in the bank's ability to repay its debts. This led to a credit freeze. Banks became hesitant to lend money to each other, fearing they wouldn't get it back. This credit freeze was like a dam breaking. It crippled the flow of money throughout the entire financial system. Businesses that relied on loans for operations couldn't get the funding they needed. Consumers struggled to access credit cards, mortgages, and other loan products. The global economy, already facing headwinds, was pushed into a deep recession. The collapse of Lehman Brothers wasn't just an isolated event. It was the trigger for a domino effect that destroyed financial institutions around the world. Stock markets crashed, unemployment rates skyrocketed, and millions of people lost their homes and savings. The 2008 financial crisis became a stark reminder of the interconnectedness of the global financial system and the potential consequences of excessive risk-taking. The aftermath and ongoing lessons learned. The 2008 financial crisis left a deep scar on the global economy. It took years for markets to recover, and the human cost was immense. Millions of people lost their jobs, homes, and savings. Businesses were forced to close, and entire industries were devastated. In the aftermath of the crisis, governments and financial institutions worked together to prevent similar disasters from happening again. New regulations were implemented to make the financial system more stable and transparent. These regulations focused on areas such as capital requirements. Banks were required to hold more capital, their own money, in reserve, making them less reliant on borrowing and more resilient to financial shocks. Mortgage lending standards. Stricter criteria were put in place for issuing mortgages, ensuring that borrowers could realistically afford their repayments. Oversight of financial institutions. Regulatory agencies were given greater authority to oversee the activities of banks and other financial institutions. These reforms aim to create a more cautious and responsible financial system. However, the ongoing debate continues. How much regulation is necessary to prevent crises without stifling economic growth? The story of Lehman Brothers serves as a cautionary tale. It highlights the dangers of excessive risk-taking in the financial system and the importance of responsible lending practices. By understanding the events leading up to the 2008 financial crisis, we can be better equipped to navigate the complexities of finance and advocate for a more stable financial future. The fall of Lehman Brothers is a complex story with far-reaching consequences. What are your thoughts on this event? How do you think the financial system can be reformed to prevent similar crises? Share your thoughts in the comments below. Let's keep the conversation going and learn from the past to build a more secure financial future. Thank you for watching this video on the fall of Lehman Brothers. If you found this informative, please give it a thumbs up and subscribe to our channel for more engaging content on finance and business. And remember, financial literacy is key. Keep learning and stay informed.